Hello and welcome to another Escala interview with the fund managers. My name is David Bruty and I am an analyst in Escala's Chief Investment Office team. On today's podcast, I am joined by Paul Moore. Paul is the founder and Chief Investment Officer of PM Capital, a Sydney-based fund manager founded back in 1998. Good morning, Paul, and thanks for joining us on the podcast today.
Pleasure.
Paul, maybe it would be good if we could start with an introduction to yourself, your background, and how PM Capital was formed.
Yeah, well, I guess, for some unknown reason, I've always, had an interest in, markets and wanted to invest, even in high school, and found my way, into a global fund manager, straight out of university. So, within 12 months, I was running a US equity fund, which today you kind of scratch your head as to how that was possible, but, effectively got thrown in the deep end of the pool and see if I would survive. Fortunately, I did survive, but in hindsight, it was a great learning tool because the US market is the market that matters. It's got breadth of industry, breadth of obviously participants. So you learn a lot about how different businesses are valued and how they operate. In contrast to, for example, Australia, which is a very narrow market, one or two stocks in each industry. So wonderful learning tool for me, reinforced my natural instincts about, the only way to really add any value as an investor is, to focus on the long term. The market's incredibly efficient short term, even when you kind of know the answer short term, the way the market will react to it turns out to be very different. And I learned that at a very young age. So just reinforced the natural instincts about investing. And so PM Capital really came out about because, I guess the business I was at was global, but it was more short-term macro. So it really, it was a bit of a fish out of water in terms of the way I went about it. So I think I was always destined to invest my own capital without constraints, the portfolio reflecting exactly what I believed, were the best set of opportunities without any interference from others. And so that was the genesis of PM Capital. And here we are almost 30 years later, hard to believe.
And can you talk us through how PM Capital invests? You did mention your long-term nature, but just talk a bit more about your investment philosophy and how you seek to differentiate yourselves in the market.
Yeah, look, I mean, you could talk about it for all day, but at the other end of the spectrum, it's all pretty simple. We don't really seek to differentiate ourselves. What we seek to do is to find opportunities that meet our criteria to provide a satisfactory return. And fundamental to that is making sure you understand the business properly, because if you don't understand the business, there's no way you can actually assess its valuation correctly and where it should sell under normal circumstances. And that's the nuts and bolts of what we're trying to do. So as I said, we don't seek to differentiate. It's just the fact that the way we go about it is very differentiated from most of the market. The market has become increasingly short term. Over the 30 years, I've just continue to see it evolve, and that's been compounded by passive, where they basically just mimic the index. So we just, we've always stuck to what we believe, for better or worse, and fortunately it's produced some solid results. But it's pretty much business common sense. Understand the mousetrap that will determine the characteristics that will determine valuation, and then the rest is being patient. Where you basically, if you look at the sort of opportunities that have really driven our returns over a long period of time, it's always where you get a severe cyclical event that the market assumes is permanent. And that comes down to their short-term horizon. They just get so fixated with what's going on today and their muscle memory, and they extrapolate the short term. Whereas what we're really trying to work out is, okay, if this is not really permanent, and then we can see some catalysts to kind of inflect those issues, that's when there's potential for an opportunity. And it's amazing. It's probably logical, but when you get these really big opportunities, it's always a point where record low valuation coincides with the extremes in the cyclicality, and they both reverse over the medium to longer term. So as long as you're willing to be patient, you ultimately can come up with some solid results.
And so what does this look like from a portfolio construction perspective? How many individual positions do you typically hold at any given time? And can you just talk to how the portfolio is built around several thematic baskets, which are long-term in their nature?
Yeah, so obviously it depends on what opportunities are out there. But if you kind of look at our history, typically we've had 6 to 8 investment themes, and each one of those investment themes might have anywhere between 2 stocks and half a dozen stocks. And so it tends to work out around about that 35, 40 stocks in the portfolio. Now, people will classify that as high conviction, which it is. We don't put anything in the portfolio that we don't have strong conviction in, longer term. But I would actually classify that as the limits of my ability to analyze companies, because once you get beyond 6 to 8 genuine investment themes and 30 to 40 stocks, you can't really stay on top of them properly. You can't monitor their progress and make sure that they're on the trajectory of your investment thesis. And so often when I look at portfolios and they've got 100 plus stocks in the portfolio, I kind of just scratch my head. And what it really means is that they're really making short-term decisions because or they're relying on law of numbers for diversification, or they're running a passive approach. But with our approach, we want to do the work properly. It can take us 12 to 24 months to complete our initial work. Do the work properly, make sure we understand the mousetrap, talk to all the people that we believe is necessary, and then come up with a proposition based on valuation. And the interesting thing is, if you do the work properly, and 9 times out of 10, when you actually buy the stock, you already know when you're going to sell it, because you know the dynamics of valuation that have to occur and the investment thesis, how it should play out. And once they're kind of exhausted, that's when you're going to sell it. And it's amazing how many times it plays out like a book. The trick though is, staying the course, because over the course of the journey, the market will throw all these hand grenades at you. Whether it's a GFC, whether it's a crash of '87, whether it's COVID, whatever, trying to scare you out of your positions. And in terms of the number of investment theses, there's no magical equation behind that. The 6 to 8. It's more the fact that if you think about our approach where they play out longer term, effectively we're kind of rotating capital from one idea to the next every 7 to 10 years. And so what I've found is that every cycle there's 1 or 2 really big opportunities that you come across, and that's where we put new capital to work. And then you got other opportunities that you might have held for 3 to 5 years, and then you got others that are like 5 to 7 years. And so you get this slow rotation of capital, and ultimately it means if we're doing our job properly the way we go about it, you're going to end up with 6 to 8 investment themes.
And Paul, you describe yourself as a contrarian investor, which sounds straightforward in theory, but can be much more challenging, I think, from a psychological point of view, requiring you to act in a different manner to the rest of the market and other investors. Can you be wrong or too early into a new idea well before an investment thesis comes to fruition? And how do you stay patient, waiting for other investors to recognize what you have already observed?
Yeah, well, you can obviously be wrong. I mean, I'd love to have every investment decision have been correct. But there's definitely been some mistakes along the way. I'd rather to kind of leave them off the equation for the moment. But you always get embarrassed by those. But typically it's because you didn't do the work properly. You took shortcuts. You didn't stick to your process and your philosophy. You can definitely be early. Very, very hard to work out the timing of when the market will respond. If you've done your work properly, you've got conviction of eventually it will come through, because at the end of the day, valuation always wins. That's the only thing that matters. So if the thesis is correct, the valuation has been bought at an appropriate price, it eventually will come through. But I'll give you one example. If you go way back to TMT, which is kind of similar to what's happening now, but back to TMT in 2000, and you had this old economy, new economy distribution in the market. Everyone was playing, the Cisco's of the world, the technology and the media telco stocks, and the BHPs and the old economy stocks were just being ignored. So, we started buying into those stocks, before the peak of the TMT. But once that cracked, we kind of kept stepping up our investments. But I distinctly remember, I think BHP was like on a single-digit PE, and there was lots of other resource companies and brewers and all these old economy stocks, and they kind of chopped around for 2 to 3 years. Now, at the meantime, the rest of the market was coming down because of the technology stocks, so we probably didn't, wasn't as much short-term pressure on us, but it did kind of shake your head for a while. And then all of a sudden, China came along, and it became more obvious that China was coming along, and commodity prices were going up, and the stocks took off. So you could have a 2 or 3 year period where the market doesn't seem to recognise them. But what I've typically found over the journey of my career is that the first couple of years, the market's ignoring them. And then around about 2 to 3 years, the fundamentals start to become obvious. And so you get people starting to rotate into the stocks. And that 3 to 7 year period's like the sweet spot. And then after about 7 years, people kind of become overconfident the other way and push it up into a period of overvaluation. And that gives you the opportunity to sell. But it can be really hard. One of our best investments, in the Brewers was interrupted by the GFC, and the stocks came down 50%. But ultimately, they went from that 10 PE to the 20 PE that we always thought they would be. The industry consolidated, and we've made multiples of our investment. But if we'd let the short term scare us out of our position, it would have all been for nothing. So I think investors just have to always realize that the market is always doing its best to try and scare you out of your conviction and your investment position. So now, you don't want to stay for the wrong reasons. You don't want to be stubborn. You don't want to have your head in the sand. That all goes back to the initial work that you did. If you've done your work correctly, that's what gives you conviction. Where you do get scared, and it's happened to me, where you get scared out of positions or you make a short-term mistake, it always comes back to the fact that you didn't do the work properly in the first place, and therefore you become uncertain and you start second-guessing yourself. So it just comes down to doing the work properly.
And another notable aspect of your fund is just its longevity. We see many other managers and funds that come and go in a short period of time, yet you have prospered and delivered strong returns for the best part of 3 decades now. What do you see as the key to long-term success in investing? And has your investment process or philosophy evolved at all over the years, or have you instead looked to maintain a consistency in your approach?
Yeah, the basic DNA of what we do hasn't changed one bit. If you read our first prospectus, you'll see that. And I think that's the trick. Too much of this industry is about trying to work out what's an easy sell in the short term. What do people want to hear? And then let's deliver that to them. But what that means is that you don't really have conviction in the investment opportunity. So I guess one of the distinguishing factors is, we invest our own capital in our funds. I was the first investor in our fund. I was the largest investor in our fund, and I still am the largest investor in our funds. The reason we get out of bed in the morning is to invest our own capital, and the clients are doing exactly what we're doing. So we're totally aligned, with the underlying client. Whereas the reality is most of the industry are managing money on behalf of other people, and they're doing totally different things with their own capital. And I think the subtle nuance of that is that when times get tough, like a GFC or a COVID or whatever, or your position's being questioned, you tend to make a different decision. You're worried more about your career risk rather than the investment risk, whereas we're totally focused on the investment risk. And I think that's what's put us in good stead at times of stress. And so it's an irony of the industry where they all, because all the literature is about thinking longer term and acting longer term, but I'm telling you, most people don't. And so what happens in this industry is that a lot of fund managers, analysts, they get thrown a lot of responsibility at a very early age, and management don't really understand investing. And what happens, if they do well in the short term, they think they're a genius. If they don't do well in the short term, they think they're a bum. But often it can be the other way around, because I went through how it can take 2 to 3 years before people start to recognize our type of stocks. But most of the industry doesn't have the patience for 2 to 3 years. And so you might have exactly the right opportunity for the next 10 years, and it doesn't play out because management undercut you because they move on to the next guy. So it's really interesting that the average duration of fund managers is like 7 years, or funds is like 7 years, but it's like that's not even one cycle. So I think if you really want to judge an investment manager, one, you need, and I'd say this, I've been saying this to our clients for a long time, even with my own team, I reckon I need 2 10-year cycles before I get a proper sense of whether they're going to be good custodians of capital. But 90% of the industry doesn't last 10 years. So it's an interesting one. So I think part of it, as I say, because we're investing our own capital, we'll be doing this till the day we die. We don't have any other aspirations. So it's a funny one, but it's a strange industry.
Certainly is. I wanted to touch on some of the investment themes represented in your portfolio at the moment. And The first of those is your core holdings in the European banking sector. What's the investment thesis behind this theme, and how much more is there to play out here after they produce such strong returns in 2025? And it might also be worthwhile just getting your view on the comparison of the European banks with Australia's banks as well.
Yeah, look, it's a great example because it's so simple. And if you go back and look at all the big investments that have a big impact on our fund over time, really simple ideas, simple businesses that we play in multiple iterations, because it's really hard to find a good idea. So when you do find one, you want to put as much capital to work as possible and play it over the longest period possible. So the European banks is your classic long-term story. And it was really simple. Pre-COVID, my sense was that we were coming to the end of the deflationary period. It was a 40-year down cycle in rates and inflation. And the reason we were coming to the end is because massive fiscal stimulus, massive monetary stimulus, and even the central bankers thought that inflation was gone forever. You remember the lower for longer story? But at the same time, you could see that geopolitics was inflecting. We're going from peace to potentially war. That's inflationary because of all the defense spending. We're reindustrializing the world on the back of net zero. Capital investment, inflationary. So you have all these inflationary factors that gave us great confidence that we're basically at the end of that story. And then if you think about, okay, well, if inflation's going to inflect, who are going to be beneficiaries of that? Well, you don't have to be Einstein to work out. Well, just look at who was worst hit by the deflationary environment. It was the European banks because they're a very generic, basic business. And when interest rates go to zero, they earn nothing on their deposit franchise. So I was like, okay, this looks interesting. This should be the biggest beneficiary. Let's go and look at it. And the valuations are at half book. They'd been through a perfect storm in terms of negative news, which was all starting to inflect. And so what we did is effectively go out and buy the CBA equivalents across Europe, Allied Irish banks, CaixaBank in Spain, Lloyds, etc. And the reason that was so obvious to us is because we came from an environment where CBA, was selling on 15 to 20 times. I forget at the time that we were buying these things, but they'd had good macro, they'd had all the benefits the other way. So we could see what a good bank would sell on in a normal environment. And then, and so that was basically the play. And then in terms of where they are now, they're halfway through the story. It's about 5 years. And I mentioned the sweet spot's usually between that 3 and 7 years. And you mentioned last year they had great numbers. So right in the middle of the sweet spot, but they haven't reached our valuation targets. A good bank in a good macro should easily sell at like 12.5 type multiple. And I would say in Europe with lower interest rates, maybe 12.5 to 15. And so until they reach those valuation targets, we're not interested in selling. And along the way, we're getting 6 and 7 and 8% dividend yields. So it's only halfway. We're going to let it play out. But the question on ASX banks is really interesting because at the start of about March of this year, CBA got up to like 26 or 27 times earnings. It was valued higher than all but, I think, Elon Musk's company, the car company, and there was one other. Might have been, it wasn't NVIDIA, but basically only 2 of the top 10. But it doesn't grow. And these things grow at 20%. Microsoft was on a cheaper multiple and it grows 20% per annum. So, the Australian banks were the exact opposite of the European banks. And that's why we went short CBA. It's the greatest anomaly I've ever seen. And it's all been driven by passive and the industry concentration of super funds here. But I think we've seen the peak, because the first catalyst was term deposit rates started to exceed dividend on CBA. Second catalyst is the competition in the mortgage market here. And, we put up a slide in our presentation which highlighted CBA versus Lloyds. And you'd swear they were twin sisters. Same asset size, same loan size, same shareholder equity. But Lloyds is making more money than CBA. But here's the catch. CBA has 3 times the valuation of Lloyds. So you're basically buying pretty similar earning streams at a third of the price in Lloyds. It's a no-brainer. As I say, if you focus on valuation, it's obvious. But it also highlights that technicals do drive markets short term. And in Australia, that passive imputation, industry concentration has really created some issues. Because people always say, but what's the catalyst? When will it change? Well, you're seeing it change because have a think about CSL. 3 years ago, it was on a 40 multiple and no one would sell it. it's had issues, acquisitions, whatever, but ultimately it was a valuation problem caused by passive and industry concentration and too narrow a market here. Ultimately CBA will deflate. Now it deserves a higher PE than offshore banks because of imputation, but it really should be in that 15 to 20 range, 20 when everything's going absolutely right, but probably more in that 15 to 20 range. So it's at least 20% overvalued.
Fair. Another theme which you've got exposure to is consumer beverages. And a question that I wanted to put to you was around whether global alcohol consumption is experiencing a cyclical or a structural downturn. And if it is the latter, how can these companies grow their profits?
Yeah, that's a harder one. That's why we're still kind of debating it, because we definitely know there's a cyclical downturn, because coming out of COVID, everyone was at home, no surprise drink consumption went up. And then unfortunately people do what they do and they extrapolate the short term and say, these guys, because they've always been a 1% to 2% grower, probably 1% over time. All of a sudden they thought they were 5% growers. No, that's just cyclical on the other side. And then with everyone going back to work, less drinking, China, harder crackdown, collapse in consumer confidence, so all the high-end alcohol collapsed. So then, we went into negative territory and everyone's starting to extrapolate that. So the hard part at the moment is there's other trends also going on. There's definitely the younger generations have definitely got a bigger health focus. We'd like to say they've gone from bar stools to barbells. They like kind of looking themselves in the mirror a little bit more these days. So, less alcohol consumption. And then obviously you've had the GLP-1 drugs, which suppress alcohol consumption. So there's a big debate. My gut feel is we'll wash out of this and not much will have changed. It'll be a very 0 to 1% volume growth. Developed markets will slowly continue to decline, but it'll be offset by emerging markets, which will have some consumption growth. And so at the end of the day, the way you grow profits, you're going to need to be very tight on your working capital, your operational costs, and use a bit of premiumization to up pricing and give all the cash flow back to shareholders. Now, the beauty of that is now that they're only selling on 12 to 15 PEs, it means you're getting like a 6 or 7% return that you can bank. And so you only need 2 to 3% growth to give you your 10% return. So I think they can still achieve that. I still think we've got a 1 year or two of washing through all of that. So if we can be patient and buy these things when they're kind of 12 and a half or lower, I think we'll be okay. But I don't think in the old days they would have sold at a 20 plus PE in normal times. I don't think that's the case anymore. I reckon it's more about 17, 18 times when things normalise. So you'll get some re-rating that amortizes over time. You'll get your cash return. So I still think you can get a satisfactory return, but I'm still debating whether how big the position size should be. It's not going to be like the European banks where you had once in a lifetime opportunity.
No, fair enough. And the last one I'll be interested to hear your thoughts on is the healthcare sector. If you think about the first couple of decades of this century, it was certainly a consistent source of alpha for active managers, particularly here in the Australian equity market, though certainly returns have been much more disappointing in recent years. What has changed, and do some of these companies now represent good value?
Yeah, so, the biggest thing that's changed is valuation. So a lot of these companies were sort of bellwether companies, and sold at very high multiples. The belief that they had consistent earnings growth over time. But people lost sight of the valuation, and they also lost sight that they're actually tough businesses because governments play a big part, and increasingly so as they continue to increase their control of the health payment system. Regulations can change overnight. And so what you really saw with, I think, Trump's second re-election was a lot of that regulation started to change, a lot of uncertainty. Then you had the disruption of the weight loss drugs. You've had question mark over AI. You've had scandals in the case of United Healthcare, acquisitions in the case of CSL. So it was a perfect cocktail of what typically happens when an industry sector becomes overvalued. But the interesting thing is, in a very short period of time, that sector has been decimated. I mean, CSL and Cochlear are classic examples. I think they're down 60 to 70%, which is quite remarkable. We're remembering we're at an all-time high in the market. So just the price action alone has attracted our attention. And that's what we do. We wait for these big cyclical events and then we go looking. Now, healthcare, as I say, it's a harder business to analyze. There's a lot of things going on. It's not like a brewery. It's pretty simple, basic stuff. Banks are pretty simple, basic stuff. Everyone can understand it. Healthcare can be a bit more complex. So we're kind of slowly working our way through the minefield, trying to work out, are there pockets of opportunity? All I could say at the moment is they definitely should be on your radar screen. And the trick, though, is working out which are the ones that have a genuine long-term business where we can have some certainty that they're going to be able to grow their earnings. And that's what we're in the process at the moment.
And if we look at the equity market this year, it has been quite volatile yet again, not least when the Iran conflict started at the beginning of March, leading to a drawdown in markets over the following weeks. How did these events impact your portfolio, and did the decline in some share prices open up opportunities for the fund? And have you been active in rotating the portfolio in the last few months?
Yeah, so at the end of the day, I mean, these sort of events shouldn't impact your long-term thesis, but they do provide opportunities to either trim or to add to your positions, or open up new positions sometimes. COVID created a wonderful opportunity in all these inflation beneficiaries. So yeah, with the Iran war and Venezuela, and I mean, the reality is the market's volatile every single year. You'd be staggered at the difference between the high and low of every single stock in the market. So it's always volatile. The difference at the moment is, if you look at the last 12 to 18 months or 2 years, is that volatility happens very quickly. It kind of goes down quick and it bounces back really quick. So it's provided us opportunities to trim some of the things that have reached our valuation targets, like copper. At the same time, it's provided opportunities to start adding positions in the spirits or one or two healthcare companies. So it's both of those. And I think that's just something that people have to understand, is that, and it's why you need to be patient, because the market will give you the opportunity to both trim and add to. But in terms of long-term positions, I say it's probably, the beverages, the healthcare that we've been focusing on recently. And it's an interesting dynamic because again, the markets have been really kind to us the last 3 to 5 years. And I think one thing that your clients need to understand is that you cannot expect those type of returns on a normalized basis. One, get back to what your ultimate long-term objective is. 2, whatever your risk level at the moment, I'd take it down a notch, because we have been blessed by good markets. But the really interesting thing, as I sit here today, is that even when I look at a market that's an all-time high, there's huge dispersion amongst the sectors. And so, as I said, I think I mentioned before, it's kind of like the TMT days where you had the old economy, new economy dichotomy. So I think you can still make a satisfactory return if you're very focused and you're very patient. But I think the market is a little bit more vulnerable to the unexpected surprise. And if you look back every 12 months and realize how many unexpected surprises occurred, I will guarantee you're going to get the unexpected over the next 12 months. And as I said, I think the market's just a little bit more vulnerable overall. So yeah, just have a little bit more in reserve so that you can be proactive rather than reactive when these events occur.
And before I let you go, Paul, maybe some thoughts on the currency, because your relatively unconstrained approach to investing also extends to managing your currency exposure as well. And so it'd be interesting to get your views on the Australian dollar at present and what your approach is, because the strength of our currency has been a headwind for many Australian investors deploying capital offshore over the last 6 months in particular. So how much hedging do you have in place today?
Yeah, so we treat, when we buy a stock overseas, we obviously have to make a decision. Do we hedge or do we be unhedged? And again, it's based on valuation. When the Aussie dollar is in its lower quartile, we hedge. When it's in its upper quartile, we're unhedged. And if you go back 12 months ago, when it got back to like 60 cents, it might have got marginally below that. I mean, it was cheap. And anyone that traveled overseas understood that. So, we've been relatively fully hedged. So, we're like 70% Aussie dollar, 15%, euro and pound, and a bit of US dollar. Now, I still think, if you look at the US, it's unbelievably expensive. So I still think fundamentally the Aussie is cheap, and relative to where commodity prices are, it should be higher. It didn't really start going up until the interest rate differentials were in our favour, and now they're in our favour. So you kind of think commodity prices, interest rates, Aussie dollar can still go up. On the other hand, I suspect the US economy continues to be strong, whereas we've got a few question marks now, particularly on the back of the budget. So I'm not sure short term as to whether, with the prospect of US rates having to stay flat or go up, that maybe there'll be a period where the Aussie dollar is a bit weak, but it will be totally driven by interest differentials and whether, the US, with the new Fed presidents, whether we can see lower interest rates over the next 12 months. Yeah, and the jury's out on that, to be honest, because as I say, the US economy has been remarkably resilient. But I think on a medium to long-term basis, I still think the US dollar is overvalued. And I think it's just benefiting from the flows from AI, the reinvestment. But I would back medium to longer term that the US dollar will weaken. How much the Aussie dollar goes up, if it does go up, I'm not sure. It's a tough one because I'm stuck between, we think it's still the commodity cycle still got a few years. Our relative debt is okay, although when you put the states into it, it's not as good as you think it is. And we've got interest differentials. But on the other hand, this budget, I think people are going to underestimate it, the impact it has. If the economy goes into a really weak spot over the next year or two, maybe that takes the upside in the Aussie dollar. So, I'm a little bit 50-50 at the moment. I'm still trying to work through it and decide what the right approach is. But ultimately, if we think the Aussie is undervalued, we hedge. And when it gets into overvaluation, we'll unhedge.
Hey, thanks, Paul. On that note, we might leave it there, but thanks for your time today in introducing the fund, and we hope to see you again soon.
Thank you for listening to Escala Partners Perspectives podcast. Be sure to subscribe to this podcast on iTunes. Escala Partners is a corporate authorized representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.